Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here is Josh Gilbert and Jeff Zufall.
Hello and welcome to Keep What's Yours with Jeff Zufall. My name is Josh Gilbert, sitting here with Jeff Zufall, the senior tax strategist and wealth advisor with Capital Advisory Group, also the author of Keep What's Yours, How to Leverage the New Tax Law to Create Unfair Advantage Over Your Competition. That's the book. This is the radio show version of it, Jeff. And welcome to the show. Can I get you a chair?
No. I've been sitting for 5 weeks, 6 weeks, something like that. So standing is great.
And this is it. This is tax time.
We are just about there.
When is tax day? It's 18th.
Tuesday.
Is there some sort of holiday or something?
Yeah, it's a
federal
Emancipation Day in Washington, D.C.
Okay.
On, well, I guess technically it falls on Monday. Falls on Sunday, so it falls on Monday as the actual holiday.
Like
so we get an extra day.
With the garbage.
Yeah.
If there's a holiday on Monday, they don't pick up my trash until Wednesday.
That's right.
I get it. That's how it works. Tax day is on Tuesday.
So
I don't really have a lot of time. And I know that Connor here at the station said, I haven't done my taxes yet. And I'm like, what are you waiting for? And he said, I'm single. I have one job.
That's right.
And I own no property. I was like, oh, you could, yeah.
So again,
on the
exactly.
keyboard.
Yeah, that's the free file. He could jump in there, do the free file, boom, be done in no time flat. Super simple.
Absolutely.
Super duper simple.
Speaking of taxes, it gets harder and harder as we get older, I feel, as we start cruising towards retirement, as we add more real estate to our portfolio, as we add more children to our family roles.
Yes.
Roll call, how many kids do we have now? It gets harder and harder and harder to do this on our own.
Yeah.
And I don't get it. You tell me this, Jeff. You've seen this more, and I want to talk to you about how it's been going the last couple of weeks. Because you stormed in here, papers falling out of your hands. You brought my tax returns.
That's right.
Do I owe money?
No.
Okay, good. That's the point.
That's the point.
But you tell me, do people come to you ever and they say, "Hi, Jeff. I was listening to the radio show. I tried to do my own taxes this year, and my computer exploded."
No, they don't say that. They say, hey, we've been listening to you for a while. We did sit down and looked at our own tax return and went, ooh, we don't want to touch it. Yeah. And that's why we called you.
Yeah. And
it's that easy.
It's that easy. And, they got TV commercials running now that they must have been listening to the show because I've been screaming, call Jeff. Why are you doing your own taxes? Have Jeff do them for you. And the TV commercials that are out now, basically, I think the tagline is, don't do your own taxes. Because why would you?
Exactly.
Why would you want to? It's a headache. It's a process. And frankly, you're probably not doing them to the best.
Exactly. There's a lot of stuff that we see that people come in and we might back up and fix a year or two. And it's crazy stuff that, again, you don't know what you don't know.
Mm-hmm.
And if you haven't dug deep into tax returns, we ran into one a real estate professional, has probably a dozen rental properties all over St. Louis. Looking at his tax return, this is the first year that we've done their return. I realized they didn't do depreciation on any of these real estate. They're rentals. And real estate is your hidden little key in a sense where you take the value of the piece of property. So say that you buy a rental house for $100,000. You get to take it and divide it by 27 and a half years, and you basically get $2,700 a year in depreciation, which is a deduction that you don't even see on your tax return. So he had a dozen properties, no depreciation. Nobody ever told him. And he was like, wait a minute.
And so what? I depreciation, that is the new frontier for me when it comes to taxes, because we've chatted about just about everything.
Yeah.
and I do want to say, I was going to get to this point, but talking to Jeff, going in and having Jeff do your taxes, he does your taxes for, last year. But one of the biggest benefits is that he gets an eye at what you're doing, and he can say, well, here's your taxes from last year.
Exactly.
But going forward for the next 9 months,
this is what you need to do.
This is what you need to start doing to keep even more money in 2024.
Exactly.
So that is, I think, what is the big reason why you go and see Jeff, because, he could do our taxes, but we needed Jeff to tell us how to do that FSA for my son's schooling. That saves us. That keeps us.
Doesn't save, it keeps.
Not savings, but keepings. On our paycheck, we get to keep $1,200 this year.
Yes.
We kept $1,200 last year.
In your pocket.
In our pocket. And we're going to Disney.
Woohoo.
My sister's kind of footing most of the bill.
That's all right.
But, that $1,200, that's going to buy a lot of stuffed animals and Mickey ears.
That's right.
So that's going to help us go on vacation. And that's money that we otherwise would have been shipping off
to the feds. You'll never see it ever again.
They don't need that.
They'd fix the potholes on the street out there, but
they probably wouldn't, though. It'll probably go to some $1,200 toilet on a submarine somewhere.
That's right.
They're trying to send people back to the moon for some reason. So.
I watch that. I hate to admit it, but when I channel surf, when I watch TV, I really don't watch anything for a prolonged period. And I stumbled on C-SPAN, and they were announcing all of the astronauts.
The new astronauts.
Yeah, so I kind of watched a little bit of that. But they had all the kids there, and they made it like a game show kind of.
Yeah.
But I was like, hey, that's cool.
I mean, it's fun. There's probably some sort of scientific benefit to this. But when I look at it and I say, would I rather keep $1,200 in my paycheck and in my bank account or send more astronauts to the moon for some reason?
That's right.
I kind of default to
look at dirt. Yeah.
Yeah. Let me keep my money, maybe, and maybe we'll go to the moon next decade.
That's right.
Anyway, depreciation, brave new frontier, and maybe we do a show about this because we got a lot of stuff to tackle today. But essentially, depreciation, how does it work? Does that just mean that over 27 and a half years, this guy can take depreciation and instead of paying taxes on?
Well, so the theory would be is like in your case, you have rental income coming in the door. But you also have depreciation, and it helps offset that rental income. Now, the bad effect or the side effect of depreciation is if you have a piece of property that you purchased and you rented it and you held it for that full 27 and a half years, you would depreciate it to zero, which means you have no basis in that piece of property. And you go, man, that's terrible. The way the current tax laws sit, if you ever sell it, you use what's called a 1031 exchange, and you sell it, and you basically push it into another piece of property, and you never pay the tax. You keep pushing it down the road. Your children or whoever your heirs are will then hypothetically inherit that piece of property on a step-up in basis, and nobody ever pays tax on it. Completely legal. So the theory is if you had, say you had a $100,000 piece of property, you had it depreciated over 27 and a half years, and it just so happened that your rent was $2,700 coming in every year, you would offset your rent right there with your depreciation, and it's a push.
Now, do you tell me this? We own a rental property with my mom. You did our taxes this year. You did my mom's taxes this year. It just seems easier. She calls me and she says, I'll just have Jeff do them.
Yeah.
And she goes, the other tax guy called me and said, hey, you ready to come in? I didn't tell him I went with Jeff. Well, you don't owe him any explanations. You're going with Jeff. Did we take depreciation on our rental property?
You did.
All right. See, and if I try to do this myself, just like this guy that just came to you with all of his rental properties, we'd miss it.
You'd miss it. Just because, again, some of them, some real estate people get it. They know that goes right down that path. And other people just, you don't know what you don't know. Yeah. So that's just one little bit right there that jumped right off the page, which saved them a bunch of money. I mean, and that's on a dozen pieces of property. We're not going to go backwards and try and reclaim stuff or anything like that. That just causes too much confusion. Just going forward, we will reset the deck and go.
And that's what I like about this show. That's what I like about Jeff's book, Keep What's Yours. It's a little kind of handheld, little handy-dandy book. it's got a bunch of these ideas in there, depreciation.
It's in there.
W-2 income, all this stuff is in there. And you kind of thumb through it and you say, oh, that actually might pertain to my tax scenario.
Yes.
You dog-ear the page, you bring the book in to Jeff and you say, page 24, page 74, and page 104, let's talk about it. And it's one thing to know. I don't know any of this. And talking to Jeff, you realize what you don't know what you don't know. But it's another thing about implementing the proper strategies. And another thing I don't know how to do. So you set us up with the FSA. You can call people's HR.
Yeah.
You know,
we
could do like a 3-way phone call.
Yeah, we do a conference call because we need you to, or you or your wife to say, hey, talk to these guys, and then they validate who they are, you know, and give us permission, and we go from there.
Yeah, and then Jeff will talk to your HR company, and you'll sit on in the background, and you'll say yes or no, and you'll say, hey, I like that idea.
Yeah.
And then you can all work something out, because the worst thing is to get to the end of the year, start looking at your taxes. You finally decided to go to Jeff, and he says, boy, you are in a really low yield, account for your IRA or your 401k.
Well, see, what we also see, and that's part of what we kind of pluck off the returns as we're doing, and we can't really have that big discussion, this time of the year just because there's too much going on.
Yeah.
But right after tax season. And that is, we see people who are high income earners who put the bulk of their money in a Roth 401k. And so if you look at it, and then they owe tax. And it's like, wait.
Yeah.
So the theory is reverse that. And again, everybody's different. The snowflake concept is very viable. But the concept is if you are at the highest earning bracket that you will be in your career, defer as much as you possibly can. Then come back at a later date. I mean, if you're at a 37% tax bracket today, the odds are when you retire, you probably won't be in a 37. Handful will, but you probably won't. And you'll fall back down to a lower tax bracket. So pre-tax the money today, take the deduction, pay less tax, put more money away, and then as you get older, you're going to take it out at a lower tax bracket.
And that's that. We talked about that a couple of weeks ago. That's the trick. And everybody knows the idea. You take money out tax-free with the agreement to the IRS.
Yeah, that you're a partner.
Either written or unwritten.
It's written, believe me.
I'm going to pay this tax later.
Yeah.
And hopefully when later comes, the tax rate is, I'm 24% right now.
Exactly.
At least I was last year. We can talk
you're
about
still
there.
Still there.
And then the idea is when I go to take it out when I'm, 65, 70, 72, 75, hopefully my tax liability is lower than 24%.
A little bit lower. Exactly.
And that's the game.
It's a game. It's that simple just to look at. Now, again, if you say, oh, man, I put all that money away and I was at a 24% bracket and I'm still at a 24, congratulations. It's okay.
Yeah,
we'll
but at least you were able to sock it away, and maybe it made more money.
Exactly.
What do they call that? Compound interest.
Compounding interest. Yeah. So again,
even if it's a wash, you probably will end up on the positive.
Yeah, to a degree. And again, that's the flip. One of the flips is everybody says, "Oh, well, tax rates are going to go up and continually go up." Yeah, I agree with that. They'll probably go up dramatically over the next couple of years. But again, that's an unknown. So you can't say, oh, I'm going to predict where tax rates are going to be 5 years from now.
But I say I want to retire in 20 years. You keep saying it's going to be more like 35.
Yeah.
35 years from now, who knows?
Who knows?
They might have gone up and then come back down again.
And the funny part is because in the tax law, no one really pays attention to this until we get off into 2024, and it'll become a huge topic. All of Trump's tax reforms, cuts, whatever you want to call it.
2017 Trump tax cuts.
Yeah, they all expire.
Paul Ryan passed it through the House and then
quit.
And then quit. My job is done.
Yeah, I'm out.
Yeah.
But again, nobody pays attention to this. So the question will be is whoever wins in 2024 controls the tax law going into 25 because they're going to have to reset everything. Whether they want to or not, it's not optional.
Whether they renew it or whether they come up with a different idea.
They could adjust some stuff.
Gone.
Yeah. So you know that the IRS, and again, that's what their job is, IRS is going to sit down, figure out where that sweet spot is, and I say the sweet spot on income brackets and ages and figure out, hey, we'll just raise taxes 3% here, and they will actually use that to create the budget going forward. That's kind of the unspoken stuff. It goes on behind closed doors. It's never really explained to people on how they do it. But they'll do that calculation, and the odds are they'll take some stuff away. They may give us some stuff, but we won't know that until 2025.
And that's the game, is to follow the news and watch your money, make an agreement ahead of time and say, I'll pay the taxes later, and hopefully you can game the system. Yeah. And it's all legal.
Completely.
It's all on the up and up. You just have to be involved with it. You can't just kind of throw it away, sock it away into an account, and just one day say, I'm going to start taking my money out. You have to have a plan. Plan. Yes. And you want to make sure that the plan is in place and thought of 5, 10, 15, 20 years.
Yeah. I mean, we do projections for people when we build the plans, when we do the financial plans. We'll go 5 years and stop. Because once you go over 5 years, you're kind of just throwing numbers out there for kicks as tax rates. We use current tax rates today, and based upon your income. Now, if your income is going to drop dramatically, that's something that we would kind of play with, but past 5 years, you can't really project because you have no idea where you're going to be.
Yeah. So it's tax planning for the future. It's tax planning for every paycheck that I get. This FSA that we have comes right out of my wife's paycheck every 2 weeks.
Yeah.
And if we hadn't set that up, we'd be funneling $1,200 to the federal government rather than going into our pockets. And if you want to know a little bit more about how that works, just call Jeff and say, give me the Josh plan. And he'll sign you right
Trademark.
up. Trademark. Yeah, exactly. And that's kind of what we do here. We let people know that there's way too much involved in this for one person or one family to kind of handle.
To sit down and play with. If it's you're going to sit down one time a year and attack it, that's borderline. And I say borderline from a standpoint, if you just had a W-2 and you're single, that's a different story. Totally different story.
File for free.
Yeah, and you basically go file for free, you jump in there, do your thing, you're done. 45 minutes probably total. But if you have assets, you have a higher income, you don't like the tax that you're paying, you can't just wave a wand on it and fix it immediately. But over a period of time, you can't. And again, like even my personal tax return, as I go through it, I actually started on it probably in January, and I'll work 10 minutes, 15 minutes a week on it. But it's the fact of sitting and looking at it and going, hey, I could shave $20 here, I could shave $30 there. And you just continuously, it's a multitude of different ideas and concepts going forward.
Yeah.
So it's not like just wave a wand and go, hey, take that one tax break and saves you. It's a series of them that you implement all year long.
And $1,200 is nothing to sniff at. Like
no,
I said,
not at all.
That's gonna
$1,200.
That's gonna put us on vacation. So
that'll buy you your VIP pass at Disney.
Yeah, a fast pass for one day. One day. So that's what Jeff can do for you. And I always tell this story. I mean, it is tax time. My sister used to do my taxes. She used to do my wife's taxes. But when we got married, bought a house, got a rental property with my mom and dad, started asking about depreciation, had college student loans rolled in there, had a baby. My sister was like, I'm not doing, I don't know. I don't do she doesn't do her own taxes because they're so complicated. She was doing ours because they were easy. Yeah. But as life gets more complicated, so do our taxes. You need somebody to, number one, do them for you. And number two, help you find ways to keep more of what's yours. And they're out there, and we just talked about them. Depreciation, FSAs, HSAs, health savings accounts. Yeah. All these these things are out there for you to take advantage of. And whether you know about it or not, number one, they're there. Number two, how do I implement them? Jeff can handle all of that for you. So I will say this. We'll go to commercial break. But Jeff is going to finish out the rest of this week. Tax day is on Tuesday. Woo-hoo. He's going to clean up the office for the rest of the week. And come Friday, he's going to hang the sign up that says we're closed.
Friday afternoon.
Yeah. When is the vacation scheduled?
It's not for a couple weeks. It got all goofed up. So.
Okay. Yeah. So Jeff will start cleaning up his office for the next 2 weeks. And
2 weeks.
Head out of town. You'll never hear from him. He'll
at least for 6 days, 7 days.
7 days. Yeah. And then he'll resurface, and you can start putting dates on his calendar, because that, I think, is the most important part of this process. Yes, you have to file your taxes. If you don't, you're going to incur way too many fines
Crazy.
and penalties from the government.
Crazy stuff that
You know,
you see.
it's stupid. Just pay your taxes. We've had whole shows about that. The penalties are like 5-10%.
Oh, yeah.
And it's just, it's nuts.
Failure to file, failure to pay proper estimated payments, not just pay estimated, but proper estimated payments.
Yeah.
And then if you owe, the time clock starts ticking on interest. The interest is a dumb rate today, so
Yeah.
yeah.
And if you're like one of these people who are like, I won't worry about my taxes, you know, let them come after me. Those people,
they'll come after you.
6, 9, 12 months from now are like, oh my God, I should have just paid them.
Those are the ones like, and I think we talked about this a couple of weeks ago. You start to see the ads now on, do you owe back taxes?
Yeah.
They're going to kick in your door tomorrow morning.
You got the
Call
IRS
us.
breathing down your neck.
And I think there was a report on maybe the news just the other day. I caught just a short minute of it talking about the scams. People saying, hey, we can save you. And there was a gentleman that was on there. I think he paid like $7,000 or some insane number to him. And they did nothing. All they did was basically deferred it for like 6 months. And that was
our
it.
job here is done.
Yeah.
It's like
And
you
then
didn't do anything for me.
And then they put him on an installment agreement. I'm like, you could go online to irs.gov and the installment agreement's right there. You can fill it out in 5 seconds
yourself.
and do it yourself.
That's all they did and charged them $7,000 for it.
$7,000.
If you need tax assistance, if you are behind on your taxes, if you do have the IRS breathing down your neck, give Jeff a call.
Yes.
Capital Advisory Group, 636-394-5524. Like I said, my favorite part about Jeff is that, yes, he does your taxes. Everyone has to do them. You got to file them. Don't ignore them. Don't bury your head in the sand. The fees are insane. But my favorite part is when he gets back from his tax holiday, when he gets back from vacation, you can get a date set on the calendar, go in and see him and say, all right, I want to do the Josh plan, or tell me how I can keep more of my money, or what do I do for the next 8 months, or how can I make sure that I don't owe next year because I owed this year.
Yes.
And, you know, maybe it's your withholdings. Maybe it's as simple as that.
About 80% of the time it's that simple.
That simple.
Now, again, looking at some of the returns as we go forward, last year, 2021, was a really good year in the market. So the dividend income and the capital gains, people trading stock or just distributions where you have no control over it, just the fund, a mutual fund itself just distributes its gains for the year, were huge. So this year, 2022, wasn't too hot in the market. Matter of fact, it was terrible. So we're not seeing the dividend distributions that high and our capital gains that great. So it's kind of pulling it down a little bit, but don't let that deceive you. Keep your estimated payments going. I mean, the market could pop in 23. If it does, then you go where you owed a bunch of tax one year, then you paid all these estimated payments and you overpaid, and then the next year you're going to end up owing again.
Yeah.
So apply some of those overpayments, apply them to the next year, and then you just kind of carry it forward. That way you don't have to pay, you don't have to write checks basically as you go forward.
One of many things that Jeff can tell you if you just go in and sit down with him and talk to him. 636-394-5524. Tax day is coming up in just a couple of days.
4 days.
So
tick-tock, tick-tock.
Yeah, don't worry about it. Jeff will do your taxes, but the biggest thing, the most important conversation is going forward. How do I make sure I can keep more of what's mine?
Yes.
Keep what's yours. That's the name of the show. It's the name of the book. And it's time for a commercial break. When we come back, I want to talk to Jeff and see, how has it been going? How has tax season been this year? Is it different than last year? Are people getting more money back? Are people paying more money? We'll find out. Keep what's yours with Jeff Zufall, 636-394-5524, Capital Advisory Group, CapitalAdvisoryGrp.com.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Welcome back to the program. Jeff Zufall here. I'm Josh Gilbert. Let's talk about this tax season. And guys, you should see Jeff. His glasses are askew. His hair looks like Dr. Emmett Brown from Back to the Future. He's wearing the same shirt that he's had on for the last week and a half. I'm kidding. He looks great, but how has tax season been? We're coming up on tax. Today is technically tax day.
Yeah, technically in the past it would be, but it's not.
But it's not, because it's on a weekend and there's a holiday and their tax day is on Tuesday. How has it been? What are you seeing? What, you have been telling us for the last 2 months that people are not going to be seeing the returns that they got last year.
They're not.
They're not going to get the money back.
Well, it's just a little bit lower, just because the stimulus checks aren't out there anymore. Child tax credits don't exist. Your little $300 and $600 charitable contributions don't exist, non-itemized.
Yeah.
And so we see, people coming in and they got stacks of, I gave to this charity, that charity, so on and so forth. $20 here, $10 there. But you need to itemize or Schedule A. So you have to go to about $13,000 single or about $26,000 married filing jointly before you even step over that threshold.
And let me ask you, going back in history here, when did they do away with the itemization, the standard
that was
deduction?
the SALT, which was state and local tax, was capped at $10,000. And when they did that in 2019, that basically took away itemization for, I'll say, 85-90% of America.
Okay. And has that we can't write off our charitable deductions, but they've kind of kicked us, threw us a bone in other areas. Has that been better for my I'm a regular guy, Jeff.
No.
Has that been better for my taxes or worse?
So in a sense, if you really look at it, and I hate to say it, but the bulk of America owns a house. The federal government helped supplement the housing market in a roundabout way because you were able to write off your mortgage interest. So let's say that you had, and I'll go back a couple of years, you had a 4% mortgage out there. You typically were able to write off the bulk of your mortgage interest, got a deduction for it, so maybe it really cost you 2%, and it helps supplement the mortgage industry. But SALT, which is state and local taxes, capped everything at $10,000, and literally it really doesn't do anything for you anymore. So if your real estate tax, and we don't really see it in, I'll say, the Midwest, we do, but we don't. If you're East Coast, West Coast, your real estate taxes are $30,000 a year. Here, 5, 7, 8, something like that, depending upon where you live.
If you're capped at $10,000,
if you're capped at 10 and you got a $30,000 real estate tax bill that you have to pay, and you only get 10 back, it's now starting to kind of pull that subsidy away, if you want to call it. I mean, it's really what it is. So what's taken place is they've brought that up numerous times to try to revise the SALT, but they're not going to do it. Maybe in 2025 when they're forced to. And when they do that, then the bulk of America can itemize again because you could use your real estate tax as part of the itemization. So if you need $26,000 and you have $30,000 in real estate tax, boom, you're there.
And that $26,000, you have to reach that threshold, married filing jointly, is that right?
Yeah.
To be able to start itemizing.
Just to start, exactly.
And most of us won't get there anywhere close to that.
But if you had $9,000 of real estate tax,
Which you can count,
or $7,000 real estate tax, and your local tax that you pay. So the tax software automatically does a calculation depending upon your zip code in your neighborhood. You have a sales tax that's calculated, or local tax, I should say. And what it's trying to do is everybody's over $10,000 pretty much always. So you're leaving money on the table, not being able to take that itemization. Yeah. So the bone they threw us was 20 and 21. Excuse me. They came along and said, "Hey, you get $300 or $600 as a non-itemization charitable contribution." That was to help charities out and help everything as we went through COVID. And then 2022, they just took it away.
Took it off.
Yeah.
Okay.
So there's nothing out there anymore. So we see people that are like, "Hey, I got all this charity," and it's like, good luck because you need a ton of money.
Let me ask you this. For some of the people that maybe they have medical bills and, their standard deduction, they're pushing the $26,000 threshold to itemize.
That's different.
Would it be worth it to donate $1,000 to the church to get you over that hump?
Exactly.
And then you can turn around and start.
And it would open up the door for itemization. So again, medical Medical is the first 7.5% of your adjusted gross income, which is a hard number to figure out unless you key it into a tax return. But the first 7.5% is on you. So you make your adjusted gross income is $100,000. The first $7,500 out of pocket, you pay. No questions asked. Anything in excess of that, you start to get to be able to write it off. But again, you got to get grand total. You got to get to the $26,000 mark, whether it's medical, charitable contributions, all that good. You get
Church
$10,000.
Tithing, all that stuff.
You get $10,000
right off the top.
Yeah, for your SALT, state and local deduction. So again, that's a combination of all those that hit that Schedule A going forward.
Yeah, well, I'm not there yet, but you'll let me know if I'm getting close.
Oh yeah, no, we do. If we calc it when we're doing the return and we're, $24,700, there's a phone call that goes out to go, hey, you got anything else? And some people might go, oh, I forgot about it. Yeah, I need that.
I did do this charitable deduction, but I didn't think we could use it
exactly.
this year.
Well, I hear that a lot after the return's done. Then they're like, well, hey, I got all this stack of stuff. And it's like, well, why didn't you give it to us?
Yeah, exactly. So. Give Jeff everything and keep it nice and neat and orderly. Yes. My wife spent some time putting everything into a spreadsheet, and Jeff just loves that. Yep. No Reebok boxes. No
those
shoe boxes.
Those are the ones you walk by and you get the shivers from, and you're like,
Kathy, that one's yours. So refunds are down just because we can't claim the charitable deductions that we did last year, and
the child tax credit doesn't exist.
Anymore. It went back to where it was.
2022. Don't forget this. We caught this one. 2022 is the last year. So if you remember back in 2020 through COVID, you could reach in and take money out of your IRA, not pay tax on it, and it would then divide it over 3 years. So, if you took $30,000 out, you go 10,000, 10,000, 10,000.
So put it back in.
Yeah. Well, don't even put it back in. Just take it out. You're going to pay tax on it. Mm-hmm. But when you took it out, you didn't have to pay tax on the full amount. The tax was divided over 3 years.
Oh, yeah. Okay. I see.
So remember, 2022 is the last year of that. So if you're doing your own return, this is something that we stumbled into early this year. Our software didn't push the calculations over.
Oh, no.
So if you were not paying attention and you were keying in the return, it would not bring that money over. You have to go force the entry, in a sense, as a brand new transaction. So if you change software providers and you did that in 2020, you still have your 1/3 due in 2022. Make sure it's on there.
I bet if you don't pay it, they hit you with a nice penalty.
It'll take them a bit. They'll catch it because that's a chunk of change for most people that we've seen. But one of them that I knew for a fact, it was, we even talked about it. Hey, it's your last year. Everything's cool. After this, you don't have to worry about it. And when I did the return, I was like, wait, that's impossible. He gets a refund. It's totally impossible. Went back, looked at it. The software did not.
It wasn't keying in.
Didn't transfer it from the previous year. So if you jumped between H&R block tax software and went to TurboTax or TaxAct, it's not going to drag that data over. You have to manually go force it. So just something to be aware of.
And again, Jeff is catching it for people when they aren't catching it for themselves.
So it was shocking that our software didn't do it, but that's whole nother issue.
Yeah. And then another thing that you're seeing is people in their Roth.
Yes.
Overfunding of Roth. I mean, you're going through, hundreds of tax returns and you're like, another overfunding of the Roth. What's going on here?
It's not bad. Again, because it's that concept. You don't know what you don't know. People are like, well, nobody told me. But I get it. I totally get it. The problem is when it gets keyed in, there's a thing called the 5498. It's really not a tax document, but it is. It's what the IRS says. It's really designed for if you put money into an IRA, a Roth, and it'll say, hey, you put $5,000, $6,000. It's a way to keep you from cheating to say, oh, I've maxed it out, and you put $50 in it. So on the 5498s, what we're catching is where people fund their IRAs. So if you have a 401k or access to a pension plan, you want to do it through your 401k. But some people will put $1,000 or $2,000 in their 401k, and then put $7,000 or try and do $7,000 into an IRA deductible, and then put $2,000 or $3,000 into a Roth. You can't do all of them.
Can't do all of them.
Yeah. So the concept is like you have
So let's run through this. Let's break it down. 401k, this is through, my work, comes out of my paycheck. What is the difference between a 401k and an IRA?
Contribution limits. Well, first would be 401k is an employer-sponsored plan, and it has way higher contribution limits to the like $20,500 range. And you could do all pre-tax. You could do all after-tax Roth. You could do half and half. You could do whatever you want.
Half and half.
Exactly. You can do whatever you want, but you have that cap of that $20,500 this last year. An IRA, depending upon your age, you're either $6,000 or $7,000, and you're maxed out. So the trick is if you don't have access to a 401k, you get to do a full $6,000 or $7,000 deductible IRA, but you can't go and do $7,000 into a Roth at the same time. It's going to cap you out. So that's where the problem comes into play. We're seeing people that did Roths multiple years and never told us until this year, because they brought us 3 or 4 years worth of the 5498 and went, oh, yeah, I think you need to see these things. And then it's like, yeeks.
Yeah. So are people not bringing these in because they're hiding them, or they forgot?
They're just they got shuffled aside. Yeah. They're not hiding them by no means. It's like, oh, hey, yeah, here's a couple.
Don't tell Jeff that we've been contributing to everything.
See, because a Roth, really, you don't get a benefit. You're not going to get a tax deduction for it.
Because you already paid your taxes.
Exactly. So it's after. So a lot of people think, oh, it never needs to go in a tax return. I don't have to worry about it. But it does, because the way that it comes out at a later date is going to be at tax return level. So 10 years from now, you say, hey, I'm going to take $1,000 out of my Roth. It shows up, that $1,000 shows up on a 1099, but a box gets checked that says taxable amount not determined. Nobody has an idea whether it's taxable or not. If your data, your contributions for your Roths are in the tax return automatically does a calculation and says, nope, return of principal, it's tax-free. It's that easy. But if you don't put your contributions in your tax return over a period of time, it's going to show up, and you got to go backwards in a sense and figure out what you put in your Roth, key it in to where it doesn't make it taxable.
And this is where things start to get goofy, because all these things have rules. We've always heard
tons and tons of rules.
5 years, 59 and a half, whatever that means. Jeff always talks about the guardrails. If you stay on the road in between the guardrails and you don't veer off into the ravine, you're going to be fine. Those guardrails are the tax code.
That's tax code. Exactly.
So there's all these rules, and I say they're goofy, but Jeff's like, that's the way that it works.
It's the way it works.
You just got to play ball. But if you don't know those rules, like these people that are coming in saying, oh, by the way, Jeff, I had a stack of these. Do you want these or not?
And it's like, yes.
Yes, I want those. We wouldn't know. How are we supposed to know? I want to get somebody on the phone in Washington, D.C. and just start shouting. How you expect us to know all of this stuff? They don't teach us this in school. They don't come to our houses and sit us down at our kitchen tables. It's up to us to either learn it on our own or call Jeff.
Exactly.
and just say,
help.
Help me. 636, by the way, is the number. 636-394-5524. Capital Advisory Group. Jeff brought my tax returns here. I can't wait to rip into these and find out how much money we're getting back.
Millions.
But who knows these rules?
Yeah, and again, it goes back to that. You don't know what you don't know. I mean, we get yelled all the time, so they're like, hey, somebody should have told us that. I get that, but there's no way I could recite those rules to you as we go forward, because some I have control over, like some accounts we manage, I'll go upside down and backwards on those going, hey, here's your rules, goods and bads. But if it's something in the outside world, I don't know you're doing it. So it's reverse. You don't know what you don't know.
You didn't bring it into me. I can't just predict what you're doing. And everything that we do causes some sort of tax liability.
Well, not so much tax liability, but it will fall on a tax return either today or later in the future, and it's going to generate something. So it's better to be prepared.
Whether they kick you back and they say, return of principal, or whether they say you owe us $10,000, whatever you do will fall on a tax return at some point.
Exactly.
So here, next year when you go in to see Jeff to do your taxes, bring everything.
Exactly.
Even the stuff you don't think matters.
Yeah. There's people that bring stuff and it's like, nope, we don't want that. We don't need it. But every year they'll bring it just for kicks to make sure.
And especially that crypto stuff because they're going to start coming after everybody.
Yes. Oh, yeah. That's next in line.
And then while we're here, the IRS commissioner just said, hey, we figured out how we're going to spend that $80 billion. Yeah. And we are going to go after some people.
They're going to go after a lot of people. They say they're only going after people that make more than $400,000 a year. And that's kind of they're trying to follow the White House's, I'll say, tune in a sense. I find that very hard to believe. Anybody that is I'll say in the gig economy, subcontractors, sole proprietors, I think you're number one. Again, their first, I say, shot across the bow was going after waiters and waitresses for unreported tips. You go, come on. But, there is a lot of weirdness in that industry. So
look, I've been in the industry. Yeah. We did keep our cash tips and we didn't necessarily declare them all. Yeah. And I'm just saying hypothetically, and technically, according to the IRS, that's against the law.
Yes.
So, I mean, you want to have sympathy for these people. But at the end of the day, the letter of the law says you have to declare your income on your tax return, and they weren't doing it.
Yeah.
So is it wrong to go after them? Is it right? I don't know.
Yeah. But again, when they say, hey, we're only going to go after people that make more than 400, and then the first people they go after don't make 400
who are working to live.
Yeah. And so you kind of go, But they're only IRS was only 2 months late on their plan, if you want to call it that. They were supposed to report to Janet Yellen, who is the Fed secretary.
You're supposed to do it months ago.
Like in January, February, first week of February, something like that. And they kind of missed their meeting, which is, I guess, I don't know if somebody called ahead or not, but they weren't there.
Yeah.
So.
Tell them I'm in the shower.
Yeah. But so that's where we sit today. So the new director's out there. There's a new IRS director. He's a month on the job now. And he was the IRS director back maybe 6 years ago, which is good because he knows
the lay of the land.
He knows the lay of the land. So it's his to get up to speed won't take nowhere near what it's somebody, a newbie coming in that, doesn't know who to talk to or who not to talk to. So hopefully he can kind of get this back under control. So,
and the idea is that they are going to go out and find not necessarily tax cheats, but people who
I won't say tax cheats, but I'll say people who just didn't report what they should have reported.
And whether it was on accident, wink, or they purposely lied on their tax return.
And again, because the IRS realizes that over COVID, so 2020 to today, literally there have been more people who have stepped up and created what's called tax ID numbers, which is, hey, I'm going to start a company. It could be a little bitty company. It could be a huge company. They go to the IRS. You fill out some paperwork. You get a tax ID number. There have been more tax ID numbers created in the last, I'll say, 2.5, 3 years than historically ever, which you sit back and go, wait a minute. So that's your Uber drivers. That's, somebody that's going to be like, hey, I'm going to do this myself. So the IRS knows there's a ton of people out there that they could, prime pickings to go see if they can get more money.
Yeah.
It's that easy.
It's that easy. And, we do need money in this country.
We most definitely do.
So they spent $80 billion, hopefully, to make, $100 billion.
I think they said that it was over, I think they did it, even though it's paid to the IRS over 10 years. I think they said in 15 years they recouped some crazy $1 trillion back. Now, how true that is, who knows?
Right. Spend money to go find money that people aren't putting on their tax returns.
Yes.
But like with this overfunding of the Roth that you keep seeing.
Weird stuff like that.
People coming in, they're not cheating on their taxes.
No.
They just don't know.
It was an oopsie.
They don't know what they don't know.
I call it an oopsie.
Yeah.
They didn't realize they couldn't do it. They assumed they could. And again, in our industry, never assume anything. But they assumed they could. They did it. They weren't trying to cheat anybody. And the concept on this is as long as you extract the overfundage, or the overfunding, I should say, out by the time that you file your return, you're completely safe. There's no penalties, no interest, no nothing.
Yeah.
So
No, all right. I like this. You said in our industry, never assume.
Yes.
Have you ever, and maybe you tell me off the air, have you ever started doing a tax return for an individual or maybe a business, and you look at it and you go,
no.
looks like you guys are laundering money.
Not so much laundering money, but you look at it and you go, that's impossible.
That's impossible.
And we have packaged it up and said, we refuse to do it.
Yeah.
We're not touching it.
Go find somebody else.
Somebody else will do it. I don't know where, but we're not.
Are you required to report things?
Technically, if you see something
fishy?
that's obvious like that, yeah. I mean, technically you should. And there's a hotline number. Even if a average consumer sees something and they go, ooh, that's blatant fraud. There's actually a tip number for the IRS that you can call.
Yeah.
Seriously. And I've had people who, it's a long story, but were ticked at somebody else and they knew that what they were doing. They called and the IRS said,
they turned them in.
They turned them in. They called in the number, but it didn't go anywhere. I mean, just fell on deaf ears. Yeah. And that's when COVID, when IRS was understaffed. So they probably really didn't have anybody to go hunt it down. Now, whether their name's still on the list.
Yeah. The phone was ringing for 6 hours.
Yeah.
That's how much spite that person had. I know a guy in St. Charles.
That's right.
Trying to claim his cat as a dependent, and then they'll come after me.
Hey, I had that question asked to me, if you could claim an animal as a dependent because they have health insurance for it.
Oh, they do? Yeah, you can get insurance for your dog.
You can get health insurance for your animals, dogs and cats, I'm assuming. And they said, well, I got health insurance. I'm paying health insurance. Why can't I write it off? And I was like, well, you got to be a dependent. And they're like, why can't I claim them? I'm like, never had a dog with a social security number, but hey.
Well, these days, people are going to probably start arguing for pets to be treated as people.
It was wild. So I was like, I've never had that asked.
What about like livestock or horses that, drag plows and stuff?
That goes under a totally different
thing.
It's not a dependent, but it's an actual investment. So it goes on farm income or farm losses, depending upon what takes place. We had one. All his chickens died, he had to kill them. They had something. He had to kill all his chickens.
I heard that there's some sort of bird flu going around, and they had to kill like 1 million chickens.
This was right in our neighborhood, and I think it was 52 that he had to kill. I mean, like, whoa, that's kind of crazy. But
yeah, but it's like, what's that person supposed to do? Can they claim some sort of
it's a long-winded loss, but yes.
Interesting. Well, we're running out of time, but rather than go to break and come back, let's just finish this out right now. I want to mention you said Seattle. By the way, 30-year fixed mortgage rate has come down.
Yes, they've come down, which is crazy. Even though the Fed keeps raising rates, the actual 30-year has come down a bit. Gets into that bond, bond backing of these mortgages, which is good. So in Seattle, the weirdest thing. So if you are you're independent, you're a sole proprietor, you run your own show, you get sick days now. So this has apparently made it through one of the commissions or whoever.
Uber drivers.
Yeah.
If they work one day, they get paid. If they don't work one day, they don't get paid. But now 5 days a week, they can say, I don't want to work, and call it a sick day.
Call it a sick day. And it's like the average of 7 average working days is how they do this calculation on what they get paid per day. I still don't know who's going to pay them, because if they're a subcontractor, you pay them for whatever that contract is and you're done. So it was kind of weird. But I can see trying to bring health benefits to somebody, but that's what ACA is for, Affordable Care Act or Obamacare. But now you have I'll call it the government getting involved one more layer, saying, hey, you're due 5 sick days even though you're a subcontractor. It was kind of bizarre.
Now, my wife was a contractor, and, she worked there for a couple of years, and then she finally got hired on by the company. And she worked 40 hours a week. She was, what do you say, she was expected to be at a certain place at a certain time every day. So I understand why that person deserves sick days, but an Uber driver, well, I'm going to work tonight, but I'm not going to work tonight.
Or I could say I don't feel like working this week.
I don't feel like working
nobody's going to
today.
yell at them. I mean,
there's no boss involved. You know,
exactly.
Hey, you didn't come in today and start Uber driving. So that's weird to me.
It's a far reach. I don't know how long that's going to stay in play.
Paid vacation, that's next, right?
Yeah, but it was sick. I mean, I can see the sick days, but still, who's going to pay it? Because if you're a subcontractor and you're working for multiple people, we're just going to arbitrarily pick somebody and go, hey, you pay it. Yeah. You pay it today. You know.
Interesting.
So,
all right, well, that's the kind of information that we provide here on Keep What's Yours. We tell you how to keep more of your money. We tell you what's out there as far as tax code is involved. We say, hey, go visit Jeff once he gets back from his vacation.
Yes.
Go get a calendar date and go see Jeff and say, how can I start implementing the Josh plan in my own? I got kids. I want to keep more of my money. I got medical bills to pay. I got this. I got that. Jeff, this is my life. How can I keep more of what's mine? That's your taxes are one thing. How do I keep more of my money? That's an every time you get paid on your paycheck stub kind of thing. And that's something Jeff can implement in your life starting tomorrow.
That's right.
Tomorrow, Sunday.
Well, no, maybe give me a couple of days next week.
Give him 2 weeks to kind of wrap everything up here. But that's the kind of thing that Jeff can offer you. 636-394-5524. Keep more of what's yours. Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Thank you so much, Jeff.
Thank you. We'll see you next week.
We're counting the days down until your vacation.
Yes.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5524 or visit CapitalAdvisoryGrp.com.